Okay, so what are you saying, people, and welcome back to your favorite YouTube channel. So today, guys, we've got another trade breakdown video for you. This time is on USDJPY for roughly around 350 pips. We'll go into detail about the trade, why I entered the trade, how I entered, stop loss, take profit, how I managed the trade, and the overall thesis for the trade as well. We go into a lot of detail about it. I've got a bunch of videos similar to this one where I break down trades as well, so feel free to go and check them out. I'll probably leave some links in the description to that. But if you guys are enjoying the content on the channel, please be sure to drop a like and subscribe. But yeah, guys, without further ado, let's get into the video. Okay, guys, so welcome to the chart. So as you can see on the screen, I've got my USDJPY long position there, roughly 350 pips, around 355 to be a bit more exact. I did share this on my Telegram, link in the description to that. But yeah, like I said, we'll go through a complete breakdown of the trade, show you what I was looking at the higher time frames, taking that lower, look at the full H, the entries on the wicks there, and how I managed the trade for a push to the upside. So we'll start on the daily, and again, I don't do too much work on the higher time frames, daily, weekly. Like, I'm just looking at key areas of value and key highs and lows. Really, I used to go into a lot of detail on the higher time frames, waiting for a lot of multi-time frame synchronicity. Which I still kind of do, but not as much detail. I'm trying to be a bit more systematic, a bit more simple with my trading. My main focus is the full H time frame, is where I map out my entries and look at my setups and actually take my trades. But I do want to be, in confidence with the higher time frames in general. So what I was seeing in the daily chart, originally I was looking for a push back down to the lows here, around just underneath 128. Eventually, we weren't actually doing that. The market started firing a lot of wicks around here and started creating some lows. So I still was expecting a move down to the lows, but eventually the market started printing some higher lows and actually just started to print kind of a bowl-shaped pattern here and started breaking through some highs, which you can see a little better on the full H time frame. As you can see, the market structure was breaking, highs were getting taken out, and the market was pushing a little bit higher. So although I was favoring USDJPY to continue lower, the market structure was changing. So I was looking for shorts, but after the structure started changing, I was pivoting towards looking for buys. So as you can see, the structure here, low, high. This is comfortable bullish structure. So at this moment in time, I've gone from looking from sells to now looking for buys. And again, my main focus is the 4H time frame. So although from a higher time frame I was expecting a push here, my main focus is the 4H. So if the 4H is shifting bullish or shifting bearish, that will be the direction I'm trading in, and then I'll look to take my positions in that direction. So as you can see, we had some bullish structure created, and we had some really good characteristics of the bullish structure as well. Comfortable swings, clean highs and lows, and also some really good impulse and momentum in the market. That's a key thing I'm looking at in my structure, that when we are having our impulsive waves, we're seeing really good momentum. Again, it doesn't have to be crazy, but we want to be seeing some strong candles pushing the market higher. You don't want to be seeing corrective moves up and corrective moves down. Those are typically not really good structures to trade. And as well, you don't want to be seeing impulsive moves up and very impulsive moves back down again. So you don't want to be seeing impulse. That's just the market that's a little bit all over the place. You want to see predominantly impulse in one direction and predominantly correction in the other. It's not going to be perfect, as you can see here, had a slight impulse to the downside, but overall the move is quite corrective. As you can see here, it moves a little bit corrective going up, then we get back to the impulse nature, impulse and slightly corrective as well. So the market's not going to be perfect. Sometimes you will get really good structures, and yeah, you want to be trading those, but sometimes you get a little bit of a mixture. But again, as long as the impulse leg is predominantly impulsive and the corrective leg is predominantly corrective, you're looking at good healthy market conditions, good structure to trade. So yeah, we're getting this bullish structure here. So all my job is, as a swing trader, intraweek trader, I'm looking to capture that next higher low for move to the upside. I actually did a full breakdown of this position here, which I didn't take the week before, for a buy in USDJPY. Saw the exact same, actually really much the exact same opportunity, really just kind of repeated a little bit more on the right there. But I did a breakdown on that on my powerful entries video, so go check that out. Really nice impulse to the upside, and all I'm looking for is an area of confluence where I can look to buy from and expect that next higher low to form. So first things first, I'm looking at the trend line here. I'm looking to see, okay, do we have that trend line confluence? We do 1, 2, 3, potentially 4. Now I'm looking at a key level of structure to buy from. The trend line's good, but again, support and resistance is more important. So I want to see if we can actually hold, a particularly good level, and we are. We've got the prior resistance here on the left. If I just move the highlight tool out of the way, With the prior resistance on the left, you can see the market was sort of breaking through it, sort of messing around with the level. Then it had a comfortable breakthrough, retested it again, and then come back for the second retest. So this is where I'm starting to get excited for my entries. I'm drawing the Fibonacci as well, and I think we came into 0.618 with a really nice aggressive wick. As you can see there, a lot of rejection at the 50, but more importantly, we had a really nice big spike into that 0.618. So I knew that, okay, we're seeing some really healthy rejection here. Most likely the market is getting ready for a move to the upside. So actually my entry is over here. In a slight wrong place there. So yeah, really good rejection out of this area. So again, I've got a really good area of confidence. Simply when the market was coming into this area, I'm just waiting to get long at this area if I get entry confirmation. Now this is where it comes to the business end of the trading. So let me delete all of this because we know the confluence is there. We've got the trend line, support, resistance, and the Fibonacci, and now we just need to wait for the confirmation. So price is coming into our area of value. We know it's there. Let me delete it out of the way. Now this is very important because it's very easy to get wicked out and faked out, especially when using candlestick patterns to enter. It's very easy to just place your stop loss below the entry candle or above the entry candle and then get wicked out on the following wick sometimes, especially when the market is a little bit volatile, because we had some news coming up for USDJPY as well, or dollar. So yeah, when I was looking to enter the market, we were coming to the support and resistance level and we started consolidating. So if I use the replay tool, kind of see it in real life action. So we started consolidating in this area. So I was looking to go long. Remember, we are in the area of interest at this kind of 133,500 area. As you can see, the market was consolidating. Now my trading hours are from around 8 a.m. to 5 p.m. UK time. So I'm looking for any possible entry candles on the hourly time frame. And what I mean by entry candle is just a big, decent bullish engulfing candle, showing me some momentum coming back into the market between those hours. So I start looking at the market from around here. So when we had this big push to the downside, it's in my area of interest, but I'm waiting for that entry candle. So as I press play, I'm monitoring the price action, not really seeing much. We're seeing price kind of messing around. Looks like we're sort of breaking to the downside. And again, if we do see a confident candle closure and price breaking to the downside, I'll just write it off and there won't be a trade for me to take. You'll be an invalid setup. I need to see that entry confirmation on the hourly. So you can see the market still consolidating, it's firing some wicks to the downside. So that's good. Now, if I can see a good confident candle closure after that, breaking outside the consolidation, I would be looking to enter. So press play, you get a nice big candle there. Didn't quite clear the highs though. So this is where a lot of people can be faked out, because yes, we do have a really nice big bullish engulfing, but you have to look at the context there is in the market. The market's very scruffy, very choppy, and the bullish engulfing hasn't really engulfed much. This is consolidation. All we've technically engulfed is candles within the consolidation, which doesn't really have any meaning at all. You want to be seeing trend shifting from bearish to bullish. So when you're having bearish structure like this and you want to see a bullish engulfing, you want bullish engulfing to indicate that this structure is breaking out and the market is pushing to the upside now. All we've got here on the left is market consolidation, up, down, and this bullish engulfing just happens to close within the range of the original consolidation. So quite frankly, we've got no shift in structure. The market is still pushing in between the resistance and support. We just got a bit of momentum, that's all we got. So frankly, for me, that candle there was just a big kind of incentive to get people sucked into trade a little bit too early. And then after that, we saw a big push to the upside. Again, failure to break above the consolidation. If we got a good candle closure above that high, I probably would have entered with a stop loss underneath that area, but we didn't. The market just faked to the upside again. Let me get the zone back in there. So the market faked to the upside again, and then press play. You can see we had a big push to the downside. This move here would have been taking out a lot of traders here. A lot of stop losses would be underneath that low. Again, remember, we're in that big area of confluence. A lot of people will be looking to buy in this area. And at this point, I thought, okay, maybe the trade isn't going to set up. Maybe it isn't going to give me an entry candle. So I was just staying patient. I was thinking, okay, maybe it's time to look at a different setup, because this one looks to be, not give me a valid entry signal. However, as price developed, we got a big push back in. and this was translating to a massive wick on the full H time frame, as you can see here. Now, the way I look to enter my trades is predominantly on bullish engulfings, good momentum, but also on fake outs, because normally when prices had a fake out, grabbing liquidity to one side, it normally means it's getting ready to go in the opposite direction. You fake out one way to go the other way. So sometimes I do get into my trades a little bit early if I see a big obvious fake out at my area of confluence, because it tells me that, okay, we faked out, we've taken some traders out in the market, now we're ready for the move. So sometimes I do get into the trade a little bit early if I do see those moves, and that's exactly what we saw here. This big push to the downside followed by a big recovery to the upside. This to me looks like a very textbook fake out, because well, number one, the characteristic I'm looking at is a big impulse down followed by a big impulse up. Those are normally what fake outs look like: impulse one way and the market impulses back the other way. So that's what we got: impulse down, impulse up. And number two, if you flick to the high time frame, it's represented by a big wick as well. So a big tip is, when you're looking for fake outs in the market, if you see aggressive price action breaking resistance or breaking support, flick to the high time frame. If it's shown, if that move that you saw in the low time frame is a wick on the high time frame and just the high time frame above, so for an hourly it'd be full H, for full hour it would be daily, daily be weekly, and so on and so forth. If it's represented by a wick, normally it's a fake out. So that's another good tip to look at. And the full H time frame is leaving us a big wick to the upside. So that told me that, okay, this push to the downside was most likely fake, and we're going to use that liquidity to start pushing to the upside. So I entered on this candle here. I could have waited for the next candle closure, which actually broke through the range, which would have been technically a safer entry. But I was very confident that this fake out was taking people out, getting ready for the trade. And now you can see a move to the upside. So that was the entry for the trade. And if I go to the full H time frame, you can see we're in a really nice area here. Big wick to the downside, taking out some traders. And then simply I was looking for my targets. Now, first target was back into the most recent high. Again, overall goal was a push into the daily zone there. Because originally I was looking for a move into this low, but more realistically, as you can see, we're printing all these high lows. Most likely the market will push back to that resistance rather than suddenly take a big dive to the downside. Unless something major was going to happen, the market always moves, or most of the time moves, in the path of least resistance. There's less resistance to go up than there is to go down. For the market to roll over, it has to break through all of these lows. For it to go up, it's got to break through that high and continue on its path it's already doing. So I was expecting price to continue back to the highs up here, but again, I don't want to overexpose myself, and I want to make sure that I'm taking my gains from the market and not just leaving a lot of floating profit, because there's a long way up. Again, roughly around 355 pips. I want to make sure that I'm banking profit. I was holding the trade over the weekend as well. A lot of things can happen. Holding big profit, 300 pips above your entry. A lot can happen. The market could pull back suddenly. So coming to this high here was the most sensible place to take profit and secure my partials. And this is where I went to break even. So we had some news. Price was dipping around. And again, it's important to stay level-headed as well, because we had this big push to the downside, that big wick to the downside. A few years ago, I probably would have closed the position early out of fear of taking the loss. But again, knowing your patterns and knowing how you trade, it gives you confidence to hold your positions. Yes, some trades will be losers, but it's important to not let the drawdown of a particular trade affect your decision making. And then we had another push to the downside with another news event, and the market went to the moon there, to the upside, smashing to the first take profit. I was actually asleep at this time, so I woke up. The market was already starting to pierce through this level a little bit. So that's when I started to take my partials and went break even. Had my second target coming into this area. This is where I took some more profit off the table. And I don't trail my stop loss, so my stop loss was still all the way down there. Took some more partials off, and then the weekend happened around here. The market reopened and then just continued to the upside into that level. So that's how we took 350 pips, roughly around 1 to 4 point something risk to reward, but with the partials it came out around 1 to 3. But yeah, really happy with the trade. Good entry, followed the plan very well, had some really good confluence, and again focusing on getting that right entry and not getting faked out too early, making sure that if you're going to enter on a good bullish engulfing, make sure it's puncturing through structure, not just closing into it, because then theoretically the engulfing candle hasn't really done much anyway. But that's kind of the overall thesis for the trade, guys. The management entry, stop loss, targets. That's the main 4 things you'll be focusing with your trades, and making sure you're taking it at the right areas. Hopefully you found this video useful. Let me know in the comments if you have, or any particular videos you want to see on the channel in the future. But thank you so much for watching the video, guys. Have a great weekend, and I'll catch you all next week.